First, Titijaya Land Berhad, a property player incorporated in 2012. As of 2024, their issued share capital stands at Rm 790 million with retained earnings of Rm 489 million. Their earnings per share saw a significant jump to 1.83 ringgit compared to 33 cents in 2023. Next is Dongguan Industries, an industrial products manufacturer established in 1994. For 2024, they report an issued capital of Rm 271.9 million and strong retained earnings of Rm 639.2 million. They also declare a total dividend of Rm 22 million for the year. Third, we have SHL Consolidate, which has roots dating back to the 1940s. Their issued capital for the year 2024 amounts to 247.7 million ringgit Malaysia, supported by substantial retained earnings of 692.2 million ringgit Malaysia. Their earnings per share is recorded at 33.76 cents. Our fourth company, Multi-Usage Holdings, was incorporated in 1991. They have an issued share capital of 73.4 million ringgit Malaysia and retained earnings of 12.7 million ringgit Malaysia for the year 2024. Their earnings per share for the period is 8.25 cents. Finally, Supercomnet Technologies, incorporated in 1990, operates in the wires and cable sector. Their issued capital for 2024 is 314.7 million ringgit Malaysia, with retained earnings of 106.5 million ringgit Malaysia. They also distribute dividends amounting to 70.2 million ringgit Malaysia to their shareholders. All five companies are Sharia compliant except for Multi-Usage Holdings.
Okay, I will talk about the different tax, specifically under MFRS 112, a key standard in financial reporting. Different tax arise when the temporary difference between the carry amount of asset or liability in the finance statement and their tax base. Under MFRS 112, we apply the liability method using tax rate they are expecting to apply when the asset is realized or the liability is settled. This ensures that different tax reflect future tax consequences, aligning accounting with economic reality. And now let me look about the different tax liability in SOFP. So now, we can see company with the highest different tax liabilities, including Supercomnet Technologies Berhad and Titijaya Land Berhad. This company may have significant taxable temporary difference, often due to accelerated depreciation of revaluation gains. On the other hand, company like Multi-Usage Holding Berhad show lower different tax liabilities, possibly due to fewer timing difference or more conservation asset valuation. So, from the analytical perspective, different tax liability can be a double-edged sword. On the one hand, they improve current cash flow by different tax payment. On the other hand, they reduce further cash flow and may distort net income in investor not adjust for temporary difference. Personally, I believe analysis always look beyond the surface. A high different tax liability is necessary bad. It could include growth, asset expansion, or strategic tax.
Next, I will continue with leases. I will explain about accounting standard and measurement, financial statement analysis, and evaluation of disclosure. The five companies using the same standard, which is MFRS 16, initial recognition is present value of future lease payment as lease liabilities or right-of-use asset. Subsequent measurement for lease liability is at amortized cost, while right-of-use asset is depreciated over the lease term. From the pie chart, shows that the highest lease liabilities is Dongguan Industries Berhad, and the lowest lease liabilities is SHL Consolidated Berhad. The advantage on lease liabilities is improved cash flow management, flexibility and obsolescence mitigation, and potential tax benefit.
Assalamualaikum and hi, my name is Nur Arisa. Let's now talking about financial assets, focusing on accounting standard and measurement, financial statement analysis, and evaluation of disclosure. Financial assets are accounted under MFRS 9. Financial assets are initially recognized at fair value and subsequently measured at amortized cost using the effective interest rate method, which is fair value through other comprehensive income and fair value through profit or loss. Based on my analysis of the five companies on statement of financial position, cash, bank, trade receivable, and other assets will give impact on the companies. On my evaluation, companies that have low financial assets are Dongguan Industries Berhad, SHL Consolidated Berhad, and Multi-Usage Holding Berhad. Meanwhile, Titijaya Land Berhad and Supercomnet Technologies Berhad have a higher financial assets. Lower financial assets will give impact on the companies, which is difficulty in meeting short-term liabilities that will make the company struggle to pay suppliers and employees. Second is reduced ability to invest or grow, which will limit the company ability to purchase new assets. Last one is liquidity problems. It will make the companies may not have enough cash to pay short-term obligations.
Hi, my name is Nur Ain. I will now discuss the financial liabilities of the 5 companies, focusing on the accounting standard applied, the financial statement analysis, and the evaluation of disclosures. All 5 companies account for financial liabilities in accordance with MFRS 9. Financial liabilities are initially recognized at fair value and subsequently measured at amortized cost using the effective interest rate method. Based on the statements of financial position, SHL Consolidated Berhad and Supercomnet Technologies Berhad have relatively low financial liabilities, indicating low financial leverage. In contrast, Tongguan Industri Berhad, Multi-Usage Holdings Berhad, and Titijaya Land Berhad report higher financial liabilities due to bank borrowings, higher purchase, and lease liabilities. As a result, companies with higher borrowings incur higher finance costs, which have a greater impact on profitability. The notes to the accounts provide maturity analysis and liquidity risk disclosures. Companies with higher financial liabilities generally provide more detailed disclosures, which improve users' understanding of financial risks. Overall, the disclosure of financial liabilities is adequate and supports users' understanding of the company's financial obligation within the sector.